everyone, and welcome to episode 215 of our Do More With Your Money show. Today I'm joined by a number of the investment management team from True Potential, and we're going to discuss the first quarter of 2024, which certainly built on a very strong environment that we saw in the end of 2023 as well. So very good returns from portfolios, from multi-asset portfolios in the quarter, but also some variation in where that has come from. We'll look to explore that today with the team. I'll just ask each of them to introduce themselves.
So I'm Chris Leyland. I am the Director of Investment Strategy here at True Potential.
I'm Kevin Kidney and I'm an Investment Director on the Growth Line team.
I'm Paul Durrance, Investment Director, also working on the Growth Line team.
Okay, so let's just get into the key topic then for discussion. The first quarter, how have asset markets performed? Maybe Kevin, will come to you first and really just discuss the backdrop of the economic data that we're seeing and the strength of that over the quarter.
So it was a quarter of surprising data strength. I think the starting point for everywhere apart from the US was quite modest in terms of expectations, so any trend change was taken very constructive by markets. So the US continues to lead. We're seeing real growth trend there above trend, which is certainly helping global equities. But that leadership really spread beyond the US. Japan did very well, and the economic cycle in Europe in particular appears to have turned. So we had very modest recessions, GDP recessions, to end 23 in the UK and in Germany, but no impact upon employment, which is really key for demand. So now that those GDP recessions appear behind us, any modest uptick in demand, obviously very favourable for equities. And the trend of data, particularly from emerging markets, the UK and Europe, is very encouraging. So we're seeing a strong impulse in data surprises away from the US, and a very strong trend remains in the US. Together, that's very optimistic for global growth.
And I think you should touch on there, the employment backdrop has been that one factor, I suppose, that has really surprised.
It's remarkable. Yeah, if we think of the global economy, the global employment cycle, we're near all-time lows in global unemployment. And it's broad, so it's the US, UK and Europe leading very strong employment cycles. And if we look at, we discuss these a lot on desk, the leading indicators for employment, no signs yet really that large corporations are in any way thinking about reducing headcount. There's some worries from some smaller companies, but many of the indicators we rely on are still very encouraging for the trend for employment.
And that's probably both across manufacturing and services.
Yes.
At this juncture, and an acceleration again in manufacturing.
What is important is services, obviously for Europe, for the US, given in general our economies are about 65-70% services driven, but no real signs at all of unemployment weakness at all, and there still remains encouraging signals for growth.
I think it's probably worth bringing that out a little bit in terms of just asset market performance. As you say, Japan did very well.
Yes.
They're up 18% in the quarter. The US is up 10% if we look at the S&P 500. But maybe there's that contrast within what equity markets did and what sovereign bond markets did for the various reasons that you're alluding to there, the strength of the economies.
I think that I would say there's one underlying trend here, which is the global economy is less interest rate sensitive than in previous cycles. So with a stronger growth trend, that has allowed market-based interest rates to rise. That, for instance, benefited European banks, had an incredible quarter, up around about 20%. Japanese financials up around 30%, both benefiting from stronger growth but higher market interest rates. And then the quarter began with the mega cap 7, these so-called tech names in the US leading, but then we saw places like the UK take over leadership, so the FTSE 100 outperformed in March, and that was because commodity strength started to come through. So many of the pillars of economic growth were all flashing green to some extent by the end of the quarter, benefiting all regions globally. Good to see so that it was the UK which caught up towards the end of the quarter.
Maybe it's worth us, Chris, thinking about that from a broader perspective then, in terms of that interest rate environment that Kevin's alluding to there, the very significant change really that we saw in market pricing for interest rates over the course of the quarter, but equity markets taking that very well. Contrast that with what we saw in the fourth quarter of last year. It was significant pricing of interest rate reductions and equity markets doing well. So can you maybe help our listeners and viewers just understand the dynamics that were happening there?
Yeah, absolutely, Jeff. So for those of you that are watching this podcast, I'll put up some charts, but I'll also, for those of you that are listening on Spotify, what I'll do is I'll just verbally walk you through the numbers as well. So if we start with the UK, as at the start of this year, there were 6 0.25% interest rate cuts that the market was pricing. It was basically similar for the US and actually very similar for Europe as well overall. It was interesting because if you looked at what the market was pricing, there was actually quite a big differential from what central bankers were telling us. So probably a good example of that would be the US. So 6 interest rate cuts priced, but then actually when you look at the forecast from the Fed at that point, it was for only 3 interest rate cuts overall. I think one thing that was quite interesting is a lot of the internal discussion that we had, but also the discussion that we have with our fund managers at that time was very much that too many interest rate cuts were priced at that juncture. Then if we fast forward, so just on the chart, this is moving from the blue dotted line to the purple line, so this is where we are today. You can actually see that there's much less interest rate cuts being priced. So basically, as at this morning in the US, you've got just under 2 0.25% interest rate cuts being priced. The UK is 2 to 3, and Europe is around about 3 interest rate cuts being priced right now. I think one thing that, and I know, Kevin, we discussed this when we did our week in markets a couple of weeks ago, and I know you mentioned this before, Jeff, but I think one thing that has actually been quite pleasing is that you've seen a real sea change in equity markets becoming much less interest rate sensitive compared to what we were seeing last year. So if you think about last year, if you would have seen so many interest rate cuts being priced out, that would have been negative for both bond markets and equity markets. But you haven't seen that this year. You've seen equity markets drive on with...
And why do you think that is the case? What's some of the conjecture that why that environment is prevailing?
Yeah, sure. It's a good question. So I think there's a few sort of features to point out. So firstly, as Kevin was saying earlier, you've seen a global economy that has proven to be very resilient. Economic growth has proven to be very strong. Mm-hmm. So the growth environment is good. I think then the second point is obviously individual equity markets are made up of individual companies. And actually, if you look at what happened in the most recent US earnings season, that was okay. That was good. So you actually saw companies were faring well. So overall, what you've seen is actually quite a favourable backdrop for equities to come through. And clearly, we just talked about the numbers there. The US up 10%, mm-hmm. Japan obviously extremely strong over the quarter. You've seen that's coming through in equity market returns.
I suppose to add to Chris's comments there, what we've also seen is wage pressures have eased, mm-hmm. and you've also had the Federal Reserve repeatedly over this quarter kind of being comfortable that whilst inflation is trending low and it has been a bit bumpy and slightly disappointing as we've found out this week, they still signal that interest rate cuts are coming this year, although that seems to be pushed out by the market. So equity markets have taken that pretty well.
Yeah, and I think we'll come back to that point about the data that we've just had over the past week to bring everybody up to speed on where we are on that. But Paul, do you maybe want to just dig into that point on equity market strength in a little bit more detail and just bring out some of the key points that you were taking away from how equity markets performed in the first quarter?
I think if we can show the visual of how equity markets performed, as we can see here, is US equities up 10. Talk about Japan exceptionally strong, up 17%. I suppose the US market always gets the headlines But it's really encouraging from our perspective, given we're global investors, is that we've seen greater breadth within equity markets. So Japan doing well, and Europe up 8% as well. And these are really, really strong returns. This is the type of return we'd expect over a 12-month period, and that would be a good result.
Yep.
This has been over 3 months, and as you started with, coming off a very strong fourth quarter last year. So it's been great for investors, even though it has been challenging at times. Kevin mentioned we've had recessions in the UK, Japan, Germany. We've had wars in the Middle East, Ukraine, geopolitical tensions. So there's always things to be concerned about. But it has been a good environment for equity markets. We think about the US, we've seen the development and further optimism over the AI trend. So that's really been beneficial from some of the mega cap technology companies, the likes of NVIDIA, up 82% year to date. And that started to filter through and filter down into other sectors that can benefit from AI. And so that's been beneficial for their share prices. But just the general broader global economic growth backdrop has been positive, led by the US, where the real GDP impulse has been most robust. But that is now starting to filter out throughout the global economy, and we've seen a turn in the manufacturing cycle. So a positive environment.
And I suppose that's the key point, really, isn't it? That we've seen that breadth of market returns. We've broadened from that narrow market that we very much discussed in 2023. In terms of Japan in particular, that being the strongest market that we've seen from an equity context, we also had quite a significant and step change from the Bank of Japan in the quarter as well. Do you want to just mention to our viewers the challenges in Japan and then the changes that we did see?
I suppose for context, Japan has been in an environment of ultra low inflation, zero inflation, very minimal wage increases, very different to what you get here in the UK or in the US. But what we have started to see is changes in terms of wage increases and inflation getting into the system, and to a level that's viewed from their central bank that's more sustainable, and that's allowed them to change their interest rate policy. So they've moved from a negative interest rate policy. We think about here in the UK, we've got interest rates at 5.25%. They had negative interest rates at minus 0.1%. They changed that this quarter to actually have a slightly positive interest rate. So it's actually quite a big change for Japan. They've moved away from negative interest rates over the last 8 years. And that's just on the basis that economic growth, consumption, wage pressures, prices is more sustainable. So it's a better economic outlook.
And it's allowed the market to regain its all-time high. It's only taken it 34 years, albeit to do that, but it's managed to do it in the first quarter.
Absolutely, and it's been a great place to be for global investors.
And Chris, Paul and Kevin have both touched on Europe and the breadth of returns in Europe. How have you thought about that over the quarter? Can you help us understand just what's been happening in Europe?
Yeah, absolutely. I think, from our own internal discussions, but also the discussions that we have with our external managers, Europe's been a fairly hot topic. It's been an area that in aggregate we have added to overall. Maybe just kind of digging into that a little bit more and how we think around that. So firstly, we see a valuation opportunity in Europe. So what do I mean by a valuation opportunity, maybe for people who are listening or watching? What we look at is how cheap individual stocks are compared to, say, a 10-year average or a 20-year average overall. So if you look at, say, where the US is right now, that's actually pricing slightly above that average. If we look at where Europe is, it depends on what sectors, what individual countries, what kind of style you look at, but it's basically pricing slightly in line or maybe just very below that average overall. I think when we look at the European economy, if we think around maybe some of the worries that we had around Europe, say last summer, Probably some of that was around gas prices. What you saw is actually Europe did a really good job of moving away from Russian gas supplies to liquefied natural gas overall. I think, again, within Europe as well, when we think around interest rates, there's the potential for the ECB to maybe cut interest rates at a faster pace compared to what we're seeing in the US overall. So I think for us, quite a bit of interest in Europe. We've had some positions that have done really well. Kevin obviously mentioned European banks. We've had some active positions there which have done well. And, with that valuation opportunity, it's certainly an area that our managers are focusing on currently.
So I just wanted to maybe turn the conversation a little bit to other aspects of a multi-asset portfolio. Clearly, we've discussed there the strength of equity markets, but we also use sovereign bonds and credit within the portfolios. The backdrop hasn't been as supportive for sovereign bonds in particular, Kevin, and I wondered if you could just bring out some of the key points of how sovereigns have performed over the course of the first quarter.
So the main driver for higher yields in sovereign bond markets, that is lower prices, has been surprising growth outcomes. Yep. So Chris pointed out that we began the year in most developed economies expecting a considerable number of interest rate cuts. With those interest rate cuts being priced out, that means the bond market, the yields there rise. Mm-hmm. But this is reflecting basically a stronger growth impulse. And that's been a headwind. The other headwind has probably been the size of fiscal deficits that continue in the US, in the UK, and to some extent in parts of Europe, in France and Italy, for example. So that is, governments are issuing bonds to finance spending and investment, and the size of deficits in, say, France, the UK and the US are nowhere commensurate with the full employment cycles we've got. Typically, the deficits we've got today are more representative of a recession, but we know we've actually got employment at extremely low levels, unemployment at very low levels. So bonds remain challenged by the size of fiscal deficit, but are also reflecting a more optimistic outlook for global growth. So it's been good for equities. It's been somewhat poorer for sovereign bonds. Yeah.
But even within that, I suppose there is slight nuances within the credit market that we've been able to exploit within it, recognising that better global growth backdrop that's more supportive for
Absolutely.
credit.
And we began the year as a team constructive on the outlook for corporate credit, and many of our managers were as well. There's interesting behaviours there. We've mentioned at the start of this podcast that we believe households and consumers are less interest rate sensitive than in prior cycles. That appears to be the case for corporates as well. Yeah. Corporates came out of COVID, very healthy cash balances, not as levered as we thought, so not as exposed to higher interest rates. And we're seeing some encouraging trends in what we describe as a default cycle, that is high yield corporates, sometimes referred to as junk names, who typically have to pay a higher interest rate to borrow. They're actually, defaults in that sector are declining. So we've not had any cuts from central banks, but we're seeing a clear change in that cycle, and that's very encouraging. That marries well with the outlook on equities, but corporate credit is certainly reflecting the strength in equity markets and doesn't appear as challenged by the rise in sovereign bond yields, the underlying rise, as in previous cycles.
And I suppose the all-in yield is much more attractive
Absolutely,
as well
yes.
than it's ever been in a historic context.
And Chris referenced a 20-year look-back horizon for equities. If we do the same for corporate credit, a number of these all-in yields, which is what we receive as investors and managers of portfolios, very attractive. And encouragingly, those yields are above inflation, so you're getting a good real yield in your coupon.
Yeah. And that's been an area, Chris, within the portfolios that you've been adding to, is that right?
Yeah, absolutely. I think, again, from an internal perspective, but also from an external perspective, high yield's an area that our managers are finding very attractive. Again, echoing a lot of the things that Kevin has just said, the high yields that are on offer compared to history. Also, if we look at things such as maybe the composition of index, the index itself's a little bit more diverse now compared to maybe what that looked like, say, 4 or 5 years ago. And actually, if we look at the kind of timetable of companies refinancing, that's actually been pushed out into next year. So in that sense, it's quite a good time, in our opinion, our managers' opinions, to be invested in high yield bonds.
Okay. And then maybe to round out our trip around the asset classes, commodities, they've certainly been that ever grind higher in the oil price. We've seen it, our listeners have certainly seen it at the petrol pump. Paul, from your perspective, what's been happening in the commodity sector? How's that come together?
It's been quite interesting, really. You've seen oil price push higher, natural gas lower, gold reach all-time highs. So it has been quite an interesting quarter. I suppose if we start with oil, that's up 16% over the 3 months. Several factors really influencing that. So OPEC, who control the production of oil, have maintained production cuts, so reducing supply, and then you've had ongoing concerns, geopolitical tensions, wars in the Middle East, but also China buying slightly less from Russia and entering more global markets. So that's all, I suppose, on a backdrop of stronger global economic growth as well, led by the US. Natural gas, we've seen weakness there as storage facilities have been relatively high in Europe, so they're at 58%, and just milder weather across Europe has helped bring down natural gas prices, which has been supportive. And then I suppose finishing with gold, which, as I mentioned, has been pushing all-time highs. There's a number of factors really influencing the gold price. Firstly, central bank buying, buying within China, both at the central bank but also the retailer. So Chinese retail investors have been hurt by their own domestic stock markets and retail markets, so they're actually putting their money more into gold. And then just the fact that the Federal Reserve have continued to indicate that interest rates will be cut despite the slightly bumpier or stickier inflation prices, but that dynamic has been supportive for gold as well. So there's a number of factors.
Okay, so there's been quite a lot going on over the quarter in terms of economic surprise to the upside, some challenges in bond markets, but also that very strong equity market performance. From a portfolio perspective, Chris, Kevin, how has that been reflected into the structure of either the growth aligned portfolio or what we've been doing at True Potential?
Well, I'll go with growth aligned and let Chris build out for the aggregate portfolios. Growth aligned, very constructive on growth, and if anything, our optimism is broadening. We believe the US will continue to lead the growth cycle, but places like Japan can still benefit. And we've talked about the mega cap 7, but more diversified indices such as the S&P equal weight, which is a sort of equal allocation to the 500 biggest corporates in the US, can do very well in that environment where global growth is broadening. And we're constructive on corporate credit. We've been somewhat cautious just on fixed income returns for, I think, the right reasons. The supply of bonds sovereign bonds in particular, is still massive. And we know the inflation cycle is a bumpy ride, as Paul said, down to somewhere around about 2% perhaps. So the portfolio, the growth line portfolios reflect that optimism, overweight equities, more nuanced and fixed income, and looking ahead, perhaps a slightly more encouraging eye towards diversifiers such as alternatives, given the growth cycle is clearly ticking up.
Just from a kind of True Potential portfolio perspective, I'd echo again a lot of what Kevin said. One thing that's been quite interesting actually is that what we've seen is the majority of our managers have actually had quite a similar view. So what we've seen is the majority of our managers have been quite overweight equity, have been quite optimistic around the global economy overall. That's not all of them. One of the really important ways that we construct portfolios is to make sure that we have managers with opposite views to other managers. So we do have managers that are maybe a little bit more cautious in their positioning overall. But I'd say in aggregate, happy to be overweight equity, regionally taking that through US, Japan. From a fixed income perspective, mildly overweight fixed income, key area that we've been adding to within fixed income is high yield. I'm starting to think a little bit more, and I know we had an asset allocation meeting actually just before we filmed this, but starting to think a little bit more around, what other diversifiers can we use? So alternative assets, the role of gold, the role of commodities within the portfolios overall.
Okay. Well, hopefully that's brought everybody up to speed of what's happened in the first quarter of this year, which built on a strong fourth quarter from last year. I just wanted to maybe use the last 2 minutes, Paul, to discuss, just to bring everybody right up to date with what we've seen over the past week, really, in markets where we used that word bumpy earlier to describe the inflation journey. It's slightly bumpier again as we look to some of the data over the past couple of days.
Yeah, absolutely. So on Wednesday we had the US inflation report for March, and it's somewhat disappointed, and it continues the trend that we've seen this year where inflation coming in above consensus estimates. So inflation came in at 0.4% for the month, and that was for headline inflation, but also core inflation. So core inflation we focus on perhaps a little bit more so because it strips out food and energy, which are more volatile, and the Federal Reserve tend to focus on this a little bit more. When we look at the year-on-year figures, we saw headline inflation creep up to 3.5%, and the core inflation remain at 3.8%. But when we look at the underlying drivers of that, it's almost down to services inflation, which is typically more sticky and often quite sensitive or correlates with stronger wage growth. And the underlying factors of that is coming through shelter, which isn't falling as much as what we'd expect when we look at more timely indicators, but also motor insurance and medical costs as well. Yeah. So there's a number of factors.
But areas that probably all speak to that underlying point that we've been talking about, the strength of the economy.
Well, that's just it. And the data print before inflation at the end of last week was the US jobs print for March, which was remarkably strong. And this is the great thing for diversified portfolios, for equities and for growth, which is the US employment cycle actually appears to be trending stronger.
Yes.
Now, so there were 300,000 jobs created in the US in through March. We would typically expect that number at this point in the cycle to be less than 100,000 to be cooling. So the fact that the US or corporate America is increasing its employment intentions is good, and that, if you take together the inflation print that Paul's outlined and the strong jobs growth, that's one of the reasons why we've seen bonds underperform in the start of this quarter, which is interest rate expectations have been pushed back even further for good reasons. Yeah. And I'll make another point on inflation if I can. The inflation impulse we're seeing now appears healthier, but still worthy of note. We're seeing it being driven by services, which is demand. We're not seeing the goods and commodity price shocks that we saw through 21 and in 2022, which was a genuine shock and caused central banks to react. This is a bit more of a nuanced challenge for central banks, where the underlying economies appear healthy and the services baskets are reflecting that. I'll make one other quick point. I think we're unlikely to see the same level of inflation impulse in the UK and Europe. We don't have the same economic strength, so we may actually see inflation here and in Europe trend towards 2% over this quarter, whereas that decline has stopped in the US.
Which will bring an interesting discussion as we probably will be looking back on the second quarter in terms of the action that central banks take, particularly with the ECB and the MPC here in the UK. Well, thank you very much to the panel today for taking us through everything that's happened in a very eventful first quarter for multi-asset portfolios in particular, with good returns across many of the asset classes in which we can invest. Please do join us on Morning Markets and our Week in Review videos to be kept up to speed about all the other events that will be happening as we look forward to the second quarter.